All right, let's get back to the state of the economy now. It's because it's what all of us are thinking about. Let's welcome in CNBC's Mike Santoli to talk about this. Mike, it's good to have you because we're all in a tailspin given the last week or so, feeling unsettled about the economy because everything is hitting us so fast, so hard, even rumblings of a recession. So what's your message to people who quite understandably feel anxious right now?
Yeah, and the markets obviously reflect a lot of that anxiety. There is a situation where we came into this year and the market was detecting signs of an ongoing slowdown in consumer activity, whether it was retail sales in the early part of the year. Walmart warned that demand was soft. Today, Delta Airlines, Kohl's, Dick's Sporting Goods. So there's a sense out there that the consumer is on a bit of a pause. On top of that, investors and business leaders are worried about the potential effects of the tariffs that might be imposed by the Trump administration, as well as immigration crackdowns. They all seem to be restraining growth. Now, I wouldn't say that we are on an absolute solid course for a recession. At this point, it just looks like a moderation in growth levels. The labor market still seems okay. We saw some decent job growth last month, but everybody is on higher alert for the potential of a bit more of a slowdown.
So given that, Mike, the general advice for us novice stock investors is to hold tight, think long term. But what if you're near the age of retirement? Does that still feel like the right course of action for those folks?
Well, it's sort of a stress test of your strategy. If by the market going down 10% from an all-time high, which is what's happened in the last 3 weeks, seems to perhaps put a pinch in your long-term retirement security and you feel as if you don't want to hold on to that type of risk, then maybe you shouldn't be as exposed to stocks as you might otherwise. If you have a longer-term time horizon, the majority of 10, 20% setbacks in the market are really not that long-lasting. Obviously, there are exceptions to this. But in general, at this point, with the economy hanging in there, it doesn't seem as if there's particular cause to believe this will be all that damaging from here.
And Mike, if we go back to the campaign, Trump promised lower grocery store prices and strength on Wall Street almost on day one. He told us about tariffs and reduced government spending. It was all supposed to be part of the plan. So a lot of voters are blindsided by the negative market reaction. What went wrong?
Well, the market did go up and celebrate a lot of those promises, the expectations for the policy mix they were going to get under a second Trump administration. We've now kind of circled back and given up those gains. I would say that the difference between now and 2016-17 is the sequencing and emphasis of policy. So we're getting an emphasis on very stiff across the board tariffs first. The immigration crackdowns is going to hurt labor supply, as opposed to back then tax cuts were the first thing on the docket. At this point, a tax package may not even be that big a deal because it's probably just going to continue the current lower tax rates as opposed to cut them further. So that's why the market, I think, is a little bit off balance with what they're getting right now.
Mike Santoli of CNBC joining us on another down day for the markets. Thanks for the insight, Mike. We appreciate it.